Silver prices just crashed 50% from their all-time high, dropping from over $121 to the 70s in a matter of weeks. You'd think dealers would be drowning in inventory, right? Wrong! Shelves are empty, premiums are skyrocketing, and wait times stretch for weeks. Saturday, February 14th, 2026, New York time. Please share in the comments what day and date you're watching this from. I genuinely appreciate seeing how far this message reaches. Before we begin, a quick note. I'm currently working to reduce copycat channels that mirror this content. If you find value in what I'm building here, the best way to support this effort is simply by subscribing and leaving the name George Williams in the comments. It may seem small, but it truly makes a meaningful difference. Now, what we witnessed in late January and early February of this year perfectly illustrates one of the most misunderstood dynamics in precious metals investing. On January 29th, silver touched an all-time nominal high of $121.67 per ounce. Just 2 weeks later, the metal had shed nearly half its value, briefly touching the low 70s. As I'm recording this, we're seeing stabilization around $77 to $79 per ounce, with today showing a nearly 5% gain. But here's where it gets interesting, and frankly, where most people get confused. During that dramatic sell-off, when paper silver was plummeting on exchanges and everyone with a trading account was watching their screen positions evaporate, something completely counterintuitive was happening at physical dealers across the country. Phone lines were jammed, websites crashed. Inventory that had been sitting comfortably on shelves for months disappeared in hours. One dealer I spoke with in Arizona told me they did more business in 3 days than they typically do in an entire quarter. Another in Florida said they had to temporarily stop taking orders because they literally couldn't process them fast enough. Think about what this means for a moment. The spot price, the number everyone watches on their screens, was in free fall. Financial media was declaring silver dead, again. Traders were liquidating positions left and right. And yet, try to actually buy a 1-ounce American Silver Eagle or a Canadian Maple Leaf, and you were either paying massive premiums over spot or waiting weeks for delivery. Some dealers were quoting premiums of $8 to $12 per ounce over spot, when, just a month earlier, those same premiums were $3 to $4. The metal was supposedly cheaper, but you were paying more to actually own it. This paradox reveals something fundamental about how silver markets actually function, and understanding it can save you serious money. The key insight is that silver doesn't exist in a single market. It exists in multiple markets operating at different speeds, with different players and different rules. When we talk about the silver price, we're usually referring to the futures price on exchanges like COMEX, where billions of dollars of paper silver change hands every day. But that's not where you and I buy our coins and bars. The recent crash from 121 to the 70s triggered something psychologists call loss aversion in reverse, or what most people know as the buy the dip mentality. When investors who had been watching silver's meteoric rise saw it suddenly half price, their brains didn't register danger. They registered opportunity. Everyone who missed buying at $30, at $40, at $50 suddenly saw a second chance. The fear of missing out transformed instantly into the fear of missing out again. But here's what makes silver different from stocks or ETFs. When you click buy on a stock, settlement happens in 2 days, and you own a digital entry. When you want physical silver, someone has to actually make that coin, ship it to a dealer, who then ships it to you. And that someone, those mints and refineries, they don't operate on internet speed. They operate on industrial manufacturing speed. Let me walk you through what actually happens when silver prices crash and retail demand surges. The global silver market moves roughly 650 million ounces through industrial fabrication channels annually, according to current forecasts for 2026. That number is actually down 2% from prior years, which tells you something important about supply constraints. Of that total, about 60% goes to industrial users: solar panel manufacturers, electronics companies, medical device makers. They're buying 1,000-ounce bars and having them processed into whatever form they need. The remaining 40% gets split between investment demand and other uses. Now, investment silver, your coins and small bars, starts its life as those same 1,000-ounce industrial bars. A refinery has to take that large bar, melt it down, and cast it into smaller bars or coin blanks. Then, mints strike those blanks into coins. Each step takes time, requires specific equipment, and involves quality control processes that can't be rushed without creating problems. Under normal conditions, this works fine. Mints forecast demand, they produce steady quantities, dealers maintain inventory, and everyone's happy. But when prices crash and demand spikes overnight, this entire system jams up. The mints were tooled up for normal production. They have a certain number of presses running a certain number of hours, producing a certain number of coins per day. They can add overtime, sure. They can run weekend shifts, but they can't double or triple capacity in a week. During the recent crash, what happened at the major mints illustrates this perfectly. The US Mint, the Royal Canadian Mint, Perth Mint, all of them saw order volumes that would normally take months compress into days. They have contracts with authorized dealers, allocated production schedules, minimum order quantities. They can't just pivot on a dime. So even though raw silver was available, even though the refineries had capacity to process it, the specific pipeline that produces retail investment products was completely overwhelmed. This is why you saw premiums explode. When a dealer normally pays $4 over spot for a silver eagle and sells it for $6 over spot, they're making $2 per coin to cover overhead, labor, shipping, and profit. But when that dealer places an order with their distributor during a price crash, something dangerous happens. They lock in their purchase price, say $75 spot plus $5 premium, so $80 total. Then they list it for sale at $85. But silver is moving 5 or 10% a day in this volatility. If spot drops to $65 while their order is in transit, customers start calling asking why they should pay $85 for something that's supposedly worth $70 now. The dealer is sitting on inventory they paid $80 for, and the market has moved against them. This happened repeatedly during the January-February volatility. Dealers who thought they were getting a deal at $78 watched spot drop to $72, and suddenly they're underwater on inventory that hasn't even arrived yet. This is why you see locking policies, why dealers require immediate payment, why premiums spike. It's not greed, it's survival. A small dealer operating on thin margins can be wiped out by a single bad week in a volatile market like we've seen recently. They're not JP Morgan with unlimited capital to weather swings. They're often small businesses running on cash flow, and extreme volatility is an existential threat to their business model. The premium spike also reflects something else that most people miss. When dealers can't get product, they have two choices: raise premiums to slow demand, or go out of stock. Many choose to raise premiums because going out of stock means losing customers permanently to competitors. But those higher premiums also reflect real market dynamics. If a dealer can only get limited quantity and has 100 people trying to buy, the price rises until demand matches supply. That's not manipulation, that's economics. Now let's talk about why retail investors are competing in a market that's increasingly crowded with industrial buyers. Silver's industrial consumption has been growing steadily for years, and while solar panel demand faces some headwinds in 2026 due to efficiency improvements requiring less silver per panel, other sectors are picking up the slack. The artificial intelligence boom is driving massive data center construction, and those facilities use silver in countless applications. Electronics manufacturing continues to expand globally. Medical devices, water purification systems, the list goes on. These industrial users create what I call a price floor. They need silver regardless of price fluctuations. A solar panel manufacturer can't just stop production because silver went up or down 10%. They have contracts to fulfill, production schedules to meet. They buy steadily, consistently, creating constant demand that removes metal from available supply. This is the 6th consecutive year the silver market is expected to run a supply deficit. Think about that. 6 straight years where demand exceeds newly mined supply. The gap is being filled by above-ground stocks, recycling, and inventory drawdown. When retail investors surge into the market during a price crash, they're not just competing with each other. They're competing with industrial buyers who have deeper pockets and longer time horizons. Industrial buyers also have relationships with refineries and can sometimes get allocation priority because they're reliable, steady customers. A refinery would rather sell to a manufacturer who buys every month for 5 years than to dealers whose orders swing wildly based on retail sentiment. The global ETP holdings of 1.31 billion ounces represent another factor in this equation. These exchange-traded products hold physical silver in vaults, taking it out of circulation. When investment demand is strong, these holdings grow, tightening available supply even further. Recent months have seen strengthened coin and bar demand, which tells us retail investors are shifting back toward physical ownership rather than paper proxies. That's putting additional pressure on the fabrication pipeline we discussed earlier. So where does this leave us looking forward from today's price of around $78? Let's think through the scenarios. JP Morgan Global Research is forecasting an average silver price of $81 per ounce for 2026. That's more than double the 2025 average, and coming from a major investment bank, it carries weight. But averages hide volatility. We've already seen 121 and we've seen 70. An $81 average could mean relatively stable trading in that range, or it could mean continued wild swings that average out to 81. The bull case for higher prices rests on several pillars. First, the structural supply deficit isn't going away. 6 consecutive years of deficit with no major new mine production coming online means the market is drawing down existing stocks. At some point, that becomes unsustainable. Second, the Federal Reserve is expected to cut interest rates by approximately 60 basis points before year-end. Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver and often correlate with precious metals' strength. Third, geopolitical uncertainty and U.S. policy questions continue to support safe haven demand. The gold-to-silver ratio currently sits at about 63-1, meaning 1 ounce of gold buys 63 ounces of silver. Historically, this ratio has ranged from 30-1 to 100-1, but the long-term average is somewhere around 60-70. We're right in that zone now, which some analysts argue leaves room for silver to outperform gold if the ratio compresses toward the lower end of its historical range. If gold holds steady or rises, and the ratio moves to 50-1, silver would need to gain significantly. The bear case, however, can't be ignored. Treasury Secretary Scott Bessent specifically called out the recent rally as a speculative blow-off driven by Chinese traders. That suggests officials are watching for and potentially ready to respond to what they view as manipulative or destabilizing speculation. If regulatory pressure increases, or if exchange margin requirements are raised, that could dampen speculative buying and pressure prices lower. The fact that we saw a 50% crash in 2 weeks shows just how fast sentiment can shift. Industrial demand presents a mixed picture. The forecast shows a 2% decline in fabrication to around 650 million ounces. That's not a collapse, but it's not growth either. Solar demand, previously a major growth driver, is facing headwinds from thrifting and substitution as manufacturers find ways to use less silver per panel. While AI and data centers are growing, they're not yet replacing solar as a demand driver. If industrial demand disappoints, it removes one of the key bull arguments. Economic data has been weakening, with December retail sales stalling and the GDP control group falling 0.1%. Weaker economic data typically supports precious metals as it implies easier monetary policy ahead. But if weakness turns into recession, industrial demand could fall off a cliff. Silver's dual nature as both industrial metal and monetary metal means it gets pulled in different directions during economic stress. Gold tends to shine in those environments. Silver can struggle. So what's the most likely path from here? Barring major geopolitical shocks or policy surprises, I'd expect silver to trade in a range between $70 and $90 for the next 3 to 6 months, with potential breakout moves above 100 if certain conditions align. The supply deficit provides fundamental support. Fed rate cuts should provide tailwinds. But the extreme volatility we've witnessed suggests large speculative positions are still in the market, and those can unwind quickly in either direction. Key indicators to watch: industrial fabrication numbers each month, ETP flow data showing whether investment funds are accumulating or distributing, mint production and premium levels as a real-time gauge of physical demand, and of course, Fed policy signals and economic data. The premium situation at dealers will tell you more about real demand than spot price moves. If premiums compress back to $3 or $4 over spot, that signals supply has caught up with demand and the retail panic has subsided. If they stay elevated at $8 to $10, physical demand remains strong regardless of what paper prices do. Here's the crucial lesson from what we've witnessed in recent weeks. The cheapest silver is calm silver. When prices are stable, when dealers have inventory, when premiums are normal, that's when you can buy efficiently. When prices crash and everyone rushes in at once, you end up paying peak premiums for supposedly cheap metal. The irony is real. The best time to accumulate physical silver is when nobody's talking about it, when the market is boring, when your friends think you're crazy for even caring about it. If you found value in this analysis of why silver shelves empty when prices drop, I'd appreciate you subscribing to the channel and dropping George Williams in the comments. The market we're navigating in 2026 is unlike anything we've seen before, with all-time highs followed by crashes that would have been unthinkable just a few years ago. Understanding the mechanics behind these moves, the real bottlenecks in supply chains, the psychology driving retail surges, and the industrial dynamics creating price floors, these insights can help you make better decisions with your capital. Stay informed, stay patient, and remember that in volatile markets, the ability to wait for the right opportunity is often more valuable than the ability to act quickly. The silver market will give you chances to buy efficiently if you're prepared and watching for them. Thanks for watching, and I'll see you in the next one.